Well, wouldn't you know it, it's time to talk taxes again. Today, we're talking about a tax rule that can save your heirs hundreds of thousands of dollars, the step up in basis. If you're serious about building generational wealth, this is something you absolutely need to understand. The IRS is going to come after your estate one way or another, but if you plan correctly, your heirs can inherit massive assets completely free from capital gains tax. So, if you own real estate, stocks, or any other appreciating assets, or you expect to inherit any, then you're going to want to pay close attention. This is how smart estate planning keeps wealth in the family. The goal of estate planning isn't just about avoiding probate, it's about keeping more wealth in your family and away from the IRS. When you sell an asset like rental property or stocks, you pay capital gains tax on the difference between what you bought it for, your tax basis, and what you sell it for, your profit. For example, you buy a stock for $100. That's your tax basis. Years later, you sell it for $500. That $400 gain is taxed at capital gains tax rates, which is usually 15 or 20% depending upon your income. Seems pretty simple, right? But what happens if you don't sell it and instead pass it down to your kids? Well, this is where the step up in basis completely changes the game. Let's say instead of selling that stock, you pass away and leave it to your children. Under Section 1014A of the Internal Revenue Code, your heirs do not inherit your original purchase price, your tax basis. Instead, the asset's basis is stepped up to its fair market value at the time of your death. So let's go back to the stock example. You bought the stock for $100, but you never sold it. When you pass away, it's worth $500. Your heir inherits it at $500, which means that if they sell it for $500, they owe zero capital gains tax. That's right, zero. The IRS acts like your heir just bought the stock for $500. The entire $400 gain disappears. And this doesn't just apply to stocks. Real estate is where this benefit really gets massive. Let's say your parents bought a home for $350,000 decades ago. By the time they pass away, the home is worth $650,000. If they sold it while alive, they'd owe capital gains taxes on the $300,000 appreciation, minus exemptions if it was their primary residence. But what if they pass it on down to you? Well, you inherit the property at its stepped up value of $650,000. If you sell it for $750,000 a few years later, you only owe capital gains tax on the $100,000 gain after their death, not the $400,000 it originally appreciated. That's $300,000 in tax-free gains that stays in the family. This is why the step up in basis is one of the most powerful wealth preservation tools in all of estate planning. But what about gifted assets? Not all asset transfers get this benefit. If you gift an asset while you're alive, your tax basis transfers to the recipient. For example, Grandma bought stock for $500 and gifted it to you when it was worth $750. If you sell it for $750, you still owe tax on the $250 gain. But if Grandma left it to you in her will instead of gifting it, well, you inherit it at its fair market value on her date of death. So if it was worth $750 at that time, then that's your new basis. If you sell it immediately, you owe zero capital gains tax. So before you start giving away assets to avoid probate, remember gifting can come with a big tax bill. Now let's step it up a notch and talk about the real cheat code for never paying capital gains taxes, combining 1031 exchanges with the step up in basis. Real estate investors know that a 1031 exchange allows you to defer capital gains taxes by reinvesting into another property. If your parents used 1031 exchanges throughout their lifetime, they could have sold and reinvested in bigger properties without ever paying capital gains tax, built a massive real estate portfolio while deferring taxes potentially indefinitely, and then when they pass away and leave those properties to you, the entire deferred tax liability disappears. That's right, all the taxes they would have owed gone. So if you own real estate, stocks, or any other appreciating assets, the step up in basis is one of the most powerful tools to protect your wealth for future generations. So here's what I want you to do. First, talk to an estate planning attorney to make sure that your assets are structured correctly. We still want to avoid probate because what's the use of avoiding capital gains taxes if your heirs are just going to be paying $25,000 just to get a hold of the assets before they can even sell them in the first place? Next, stop thinking gifting avoids taxes. It can actually make things even worse. A tax bill for them, no step up in basis, and a tax bill for you, the gift tax, which I've talked about many times before. And finally, if you're a real estate investor, start thinking about combining 1031 exchanges with the step up in basis to eliminate capital gains taxes permanently. I've done deep dives into how to build generational wealth and 1031 exchanges, so I'll link to those videos in the corner. Don't leave money on the table. Get your estate plan in order, otherwise Uncle Sam will come and take a bite from it. The best time to plan was yesterday, the second best time is today. If you found this helpful, drop a comment below. Did you already know about the step up in basis, or was all this new to you? Curious on how this can fit into your estate plan? Let me know. And as always, like, subscribe, and share this with someone you know who has been procrastinating on planning their estate. I'm attorney Andrew Bethel, and I'll see you at our next meeting.